Welcome to Street Check, the weekly podcast from Cabot Wealth Network, which has been publishing investing research, insights, and recommendations since 1970. I'm Chris Preston, Vice President of Content and Chief Analyst of Cabot Stock of the Week.
I'm Brad Simmerman. I'm the Managing Editor and Chief Analyst of the Cabot Wealth Daily Newsletter. Every week, we like to start off with our big three news stories. This week, we'll be discussing China's GDP numbers. We'll be touching on Tesla's earnings, and then a look at the regional banks as well now that they are beginning to report. Then after that, we typically like to follow up either with a guest or with a deep dive into another conversation topic. And this week, we will be discussing the FAANG stocks, the genesis of the term, whether we need to shake things up and whether they're still investable.
Yeah, and before that, we are going to do what we call defend the take, where one of us defends sometimes a ridiculous take, sometimes a very sensible take. I think today, Brad, you're up today. I think yours is more the latter. But your defend the take is the VIX dropping to 18-month lows, which it did, is actually bad news. VIX being the volatility measure in the market. You have 90 seconds to defend your take. Go.
So the obvious data point, right, is October of 2021, last time that we saw the VIX this low, and that was right before the big correction, the sell-off in 2022. But really the reason that I want to touch on it being bad news for stocks is because of market psychology. So the VIX is a measure of out of the money call and put contracts on the S&P 500, right? What it measures is fear and greed. The fear that an existing position gets cut down, so you have protective puts that you're buying, you're hedging, you're doing things like that, or high levels of speculation, right? So buying speculative calls, you expect things to go up. When the VIX is low, it's signaling that that kind of activity just isn't happening at high volumes. And it reminds me of a data point that Mike Santolo, the chief analyst of Cabot Growth Investor and Top 10 Trader, shared in a recent issue of Growth Investor. Institutions just aren't invested right now. They're overallocated to cash significantly, something like 45% of big institutional investors in a survey that Mike cited were overallocated to cash, and high 30% was underallocated to equities. So I think that the reason that the VIX being this low is a bad sign for us right now is that it doesn't portend a lot of expected moves. It just means we've got more chop, probably more range-bound trading ahead.
Was that your 90-second timer that went off about 10
that
seconds?
That was, yeah.
Okay,
yep.
Yeah, you almost made it.
Almost, right at the bell.
Do you need another 15 seconds like I did last week?
No. I think my point is made. It's just it's a marker of underinvestment by big firms. So that means that it's going to be retail driven, which means we're going to keep getting more chop and probably not a lot of directionality.
Yeah, I mean, the last couple times we saw the VIX dip this low last August, I believe, which was right before stock sank again. And then prior to that, there was a dip right before the bear market began, at least for the NASDAQ in November 2021. Like October, November 2021 was the last time the VIX dipped to like 15. And we saw what happened after that. I don't think it means we're going to, going down the roller coaster again, but it tends to be kind of a calm before the storm thing. Hopefully the storm is more minimal than that one.
Yeah, in absolute terms, the raw number, the 16.2 or the 17.4 or whatever that it's at now, that's a reasonable number for the VIX. It's just the outlier in the fact that it's such an outlier right now relative to where it's been in its recent range is more where the bad news is coming in. Which I think it's just it's an indicator that there's not a ton of activity among big institutional investors that needs hedging.
Right. Yeah. And I misspoke. It was not it was not this low last August. There was a dip, but it wasn't this low. The last time it was this low was that November 2021, which was right before the bear market began, essentially. Okay. Yeah, that's a good take. I agree with it. And I think yeah, it's a good time to take some caution, even with the VIX at this low. Let's move to our big three. Number one is China GDP. They reported GDP this week, 4.5%, which was its best since Q1 of 2022. It dipped as low as 0.4% a couple of quarters ago. It was 10.6% retail sales growth in March, which was a 2-year high. Factory output, 5-month highs. Jobless rate dipped to 7-month lows. China making a comeback. Do we think it's a good time to invest in it? I mean, is China essentially because of their, draconian COVID policies dragging on way longer than ours, 18 months longer, give or take, than ours? Is China where we were 18 months ago in 2021 when our economy boomed?
Yeah, I think that's a really good take on it, because if you look at what the expectations are going forward, I think I've seen 5.1 or 5.2% GDP growth for the year is expected, and then similar numbers next year. But a lot of it is also being attributed to that jump in retail sales, and you're seeing a lot of reporting that consumers are spending even just to splurge, right? They're just
Yeah.
spending money because they've been trapped inside for 3 years effectively. They need the outlet, they need to spend the money, which is the same thing that we saw where, for the last 18 months, our economy has been held up by this repressed spend and by a resilient consumer. But now we're slowing down. Now we're, presumably approaching a recession. Is the same thing in the cards for the Chinese consumer? Maybe. I
Yeah.
mean, it's definitely possible, but at the very least, you've probably got, a year of runway for them to continue spending. I mean, if you look, I guess the important question is like, all right, well, what do we do with the information, right? Like, can you invest in China now? Is it safe to be there? Which I think comes down to maybe more of what your fears of regulatory risk are, right? Like Baidu just broke up into 6 different companies or announced plans to do so. They signaled that they're sort of working with senior party leadership to accommodate their wishes while also growing. And China is a little bit permissive when it comes to tech companies growing. Like they'll let WeChat is immensely popular, even though it presents an opportunity for citizens to maybe use talking points that are sort of outside the official narrative. So there's some forgiveness with tech companies, but that regulatory risk is always a big overhang, especially if we see more animosity towards China in the States, politically. One thing that I think is maybe a better play than going directly to China is looking at maybe some U.S. companies that are poised to benefit from another year of heavy expenditure by the Chinese consumer. So, one company that is certainly on our radar periodically is Las Vegas Sands, right? They own,
LVS.
you know,
Ticker symbol. Yep.
LVS. They own properties in Macau, and they benefit greatly from the Chinese consumer, opening up the pocketbooks, opening up travel, stuff like that. But they're not really as subject to the regulatory risk because it's a lot harder to step in and seize a physical casino in Macau than it is to force delisting of shares somewhere. So
Right.
I think that's the play, maybe more the play to look for.
Yeah, and Wynn Resorts, MGM, also have properties in Macau. They've been trending pretty well too. Gaming companies in general, some of the biggest gaming companies, almost all of them have a presence in Macau now. Just we're seeing more positive news about Chinese companies since the reopen this year. Alibaba, splitting into 6 companies, which they'll spin off 5 IPOs or whatever. I can't say I'd advise buying any of those, at least at first, but it puts Alibaba sort of back on the radar. Alibaba's having, Baba stock is having off to a good start this year, which that used to be, one of the crown jewels of the market, regardless of nationality. BYD, which is sort of the Tesla of China, that just in the first quarter surpassed, in terms of pure battery electric vehicle sales, surpassed Tesla's for the first time ever, I believe. And their margins, we'll get to Tesla, but their margins are actually better than Tesla's or were in the first quarter. So there's a lot of good news, good things happening with Chinese companies. Like you said, because of regulatory issues, investing in a pure Chinese stock can be a difficult sell, but China's trending in the right direction, where it's not a complete stay away like it was for most of the last year.
Yeah, and there's still some weakness in some of the business spending that probably portends slower economic growth a year down the road. But for the time being, like you said up top, they're about where we were 18 months ago, and 18 months from now, they'll probably be close to where we are today.
Yep.
I mean, that's just sort of the nature of the global economy now.
Yeah, exactly.
But one thing that you touched on with BYD is Tesla. So it's a perfect segue, perfect time for us to talk earnings. Market didn't like what it saw. What was your take? What did we expect, and what did we get?
Yeah, I mean, Tesla had a bad 2022. The stock did, but a lot of that, especially in the latter part of the year, had to do with Elon Musk. A lot of things that he said, everything he did with Twitter. Tesla was collateral damage with that. This time it had to do with the company itself. Tesla, as people probably know, making price cuts. Might not know how many since the start of the year. They've made 6 price cuts to some of their high-end vehicles, Model 3s, Model Ys. Model 3s, 11% cuts in total, 11% off of the price that it had at the beginning of the year. Model Y down 20%. And that has put a dent in Tesla's famously wide margins. They dipped below 20% first time in a while, behind BYD. And while revenue was up 24%, net income, EPS down 24%. This is what people were afraid of with all the price cuts. Elon is saying we don't care about margin as much. We care about volume. We'll see if the strategy works, but so far, investors don't seem to like it. What do you think this means for Tesla going forward?
So what I want to try and do is climb inside Elon's head a little bit and speak on his behalf. When he says volume is important, and in the conference call, he also said that the big revenue driver moving forward is going to be subscription revenue. So something like full self-driving, right? Right. It's essentially the Gillette business model. It's you give away the razor, in this case, the Model Y or whatever, for what is essentially free, and then you charge people reoccurringly for the replacement razors themselves. But I think that there's another motivating factor there to the volume piece, and that's data quality. Because every major automaker has some degree of electric vehicle, some level of driver assist. Everybody's sort of heading in the direction of a self-driving or a smart vehicle. If you've got one Tesla on the road and it slams to a stop in the middle of the freeway for seemingly no reason, it can be tough to get good data quality about what actually happened there. If you have 3 Teslas on the road, all encountering the same thing, they can reinforce the data points that you're picking up from the visual sensors, from the LiDAR, from whatever radar. You can reinforce your data quality by having more vehicles on the road, and essentially create a smart network of cars that can teach each other, that can then improve the quality of the self-driving. So it's not that Tesla's self-driving technology is going to be better than GM's, right? Their Cruise unit uh, is probably the top competitor for self-driving. But it's not that they're going to be better just from the jump. It's that if Tesla can hit its volume targets, it can evolve its self-driving in a smarter and faster way and ultimately make it a better product through repeated iteration and upgrades. So I think the big picture strategy is sound. It's just a matter of logistics and putting it into play.
Yeah, and like Kathy Wood pounced on the stock after its drop. I don't know if that carries the same weight it would have a couple of years ago before, all things ARK plummeted. But maybe this is a buy the dip situation. I mean, Tesla was off to a good start this year, granted, coming off of a terrible, like I said, down 60% in 2022. It was off to a good start. It was really taking off. It's kind of like if a rocket took off and then everyone's like, yay, it's headed, it's up there, it's headed to space, and then just sort of exploded. It's sort of what it feels like a little bit to me with this earnings report this week. Just the first example that came to mind.
Yeah, just apropos of nothing, just
Yeah, yeah,
failed rocket launch.
right.
Although, I mean, I guess like the thing is, all right, people were betting against Musk and Tesla when they were cash flow negative and taking losses on every vehicle, and they grew market share from like 1 to 4% of cars on the road and reached profitability. And sometimes these moonshots take a long time. But Elon doesn't seem as concerned with the short-term margins as he is with sort of being the next Henry Ford.
Yeah,
And I think there's always a chance. He's always got the puncher's chance that actually pans out.
yeah. And that blue check on Twitter is really revolutionary too. Let's move on to number three in our big three, the banks, regional banks. Last week we touched on. Last week was we were talking as a lot of the biggest banks were reporting earnings, which are mostly good. Regional banks been more mixed this week, but there hasn't been a whole lot of sign of contagion to the point where it looks like another regional bank might fail. It just looks like a weak, but sort of garden variety weak quarter. What is your take?
Yeah, after SVB failed, the fear was like, all right, well, regional banks are going to get destroyed. There's going to be this mass exodus to big banks, and then a somewhat reinforcing data point was coming in the form of the big banks' earnings reports and their announcements on how much they saw deposits increase. And then what we ended up seeing as the regional banks started reporting this week is what we probably should have expected to see, which is a little bit of deposit decline, increased provisions for loan losses. Western Alliance was the first one to report. They came in with an 8.8% decline in total deposits, which was left them with 47 billion still on the books, down 11% from Q4. Zion's Bancorp reported earnings that were up like 20%, but even they lost deposits, down 3.3% from the fourth quarter, 16% from last year. And then they saw increased provisions for credit losses to 45 million. That's up 2 million. So what we're seeing with these regional banks is that things aren't as bad as everybody was maybe prepared for when SVB failed, right? There was a lot. It was just this failure of the SVB turned out to be exactly what people thought it was, which is a bunch of rich tech bros freaking each other up via a Telegram channel. And then SVB was sort of this one-off in terms of deposit quality and the assets that they had. So this is playing out as we should have expected and is probably a good sign for the regional banks. I mean, maybe you get some consolidation if earnings remain weak for 2, 3, 4, 5 quarters in a row. Like if we get into a recessionary kind of slog, you'll get some consolidation maybe, but I'm not worried about a bank failing right now.
Yeah, I mean, this first week of earnings is sort of confirmed the idea that the contagion didn't spread any further than what it already has, that the bleeding is stopped. You can make the case that there's some value to be had in buying certain regional banks. Harder to identify which ones. I think Bruce Kaiser, our chief analyst of our Cabot Undervalued Stocks Advisor newsletter, has done just that. I think he recommended a regional bank or two recently, because they've just been holding the KRE, which ETF that tracks regional banks, has just been holding steady even through the last week of ups and downs, since it crashed in early March. It's just been flat. So you could make a case that it's a value, just some value here.
Yeah, if I'm walking away from this earnings season with one takeaway, is that I feel really good as a depositor if I'm working with regional banks. Still not feeling so great as an investor, though.
Yeah,
right? Like
fair.
they're
I'm
facing
not
the
buying
same.
any. I'm just saying you can make the case. But
Yeah, they're facing the same economic conditions as everybody else, so they're probably not a smoking hot steal right now. But as a depositor, I think you're definitely safe.
Right. Should we move on to our theme for the week?
Yeah, let's talk FAANG stocks a little bit. So the term FAANG was originally Facebook, Amazon, Netflix, Google. Early 2010s, Jim Cramer helped popularize it. 2017's FAANGs were FAANG, so they added Apple based on its performance. These stocks became like the white whale of the investing world. Um, they were put on a pedestal. They represented like 20% of the gain in the S&P 500. Everybody wanted the next FAANG stock, the next like mega cap, multi-bagger tech stock. So one question I've got is, how do we define something like that? I mean, it caught on because it sounds catchy, FAANG. But it's very much a vanity definition. So I don't know if there's maybe a better definition for, or a better way to classify these mega cap tech stocks. The other thing to look at is, are they still a good metric for what they were originally set up as, which was these moonshot great tech companies? Are they still representative of that now with that composition? Do we need to eject some from the group and come up with a new acronym that makes more sense or that's more fun?
Yeah, relegation, like Premier League
Yeah, exactly.
soccer style. Yeah, I mean, I'm looking at Netflix and Facebook, Meta, whatever. Even though, I know Meta in particular is off to a good start this year. The things are always about, these aren't necessarily the five biggest, best stocks. They're the for lack of a better term, sexiest stocks. The sex appeal is what makes them, why people talk about them, which is why Microsoft, which probably belongs in the same breath as a lot of these, was not part of it, because Microsoft's not really in the news much. They've been doing the same things. I know maybe more now that they're part of the AI, at sort of the forefront of the AI movement, maybe now, and maybe that's the answer. What should replace a Netflix or a Facebook? Tesla certainly, even though we just talked about it, it's fallen on hard times. But in terms of sex appeal or people talking about it, that's certainly up there and been up there for a while. In terms of just their sway over the market, they legitimately, these stocks did sort of move the market, especially when times were good during the bull market. As they went, sort of at least the Nasdaq went, or tech stocks as a whole went. That's not really the case anymore. So in terms of their influence, I think the stocks themselves aren't dead, but in terms of their influence as just complete market driver, I think that's mostly over. What do you think?
I think you hit a good point with the sort of sex appeal of it. It's the common thread with the FAANGs was like revolutionary consumer tech.
Yeah.
And that's not something that you would see with Microsoft, even though it boasts the market capitalization, the cash on hands, the returns, certainly the pervasiveness of any of the FAANG stocks, and better profitability than Netflix certainly, Meta as well. I mean, unless they just put the kibosh entirely on their metaverse play, that was a $10 billion mistake. But they've still got 40 billion in cash on hand. So you know, I wrote a daily post about somewhat about this topic, about how you would choose to include or exclude a company from a list of like mega cap consumer tech names. And market cap, above a trillion is like one reasonable cutoff, which keeps Facebook off the list. The amount of cash on hand is an important one, and it gets back to something that I think is increasingly in the popular narrative around the market, which is people are looking for like safety and lots of cash and big tech, and like the FAANGs sort of tick all those boxes. But I would be very hesitant to say, okay, well, all the FAANGs are big tech companies that we can buy because they'll be nice and safe. I would treat that as a very distinct group from the Microsoft, the Apple, Meta to some degree, the Amazons. So I don't know that we need to blow up FAANGs as a concept. I think we just need to do a really good job of delineating between consumer tech stocks and safe haven tech stocks.
Yeah, and things change. The market changes, the economy changes. 20 years ago, the 5 largest stocks, well, Microsoft was in there as number one. This is by market cap. General Electric, ExxonMobil, Walmart, and Pfizer. Now, most of those companies are still large, but they just don't move the needle, aside from, maybe Microsoft.
And Exxon
don't really
cyclically.
move the, yeah, cyclically, but no, who talks about Exxon? You ever hear anything about Exxon? Microsoft, because of AI, yes, but the rest, no, and GE especially. 10 years ago, Apple was in there, but there was also IBM and Chevron. Now Chevron, similar to Exxon, same thing. No, that's not something people talk about anymore, even though it's still a large company.
Is a better definition the stocks that you would brag about owning or making like a 2x on at a cocktail party? So it's like,
right.
So maybe it's like, all right, well, yeah, this company Inspire Medical, right? Like that's, yeah, I made 200% on that, and you're like, you'll brag about that. But if it's Exxon Mobil or like Altria, it's like nobody's celebrating making 200% on a cigarette company or on an oil company. Maybe that's
right.
the definition.
Right. Yeah. And there's been companies in the last couple of years. We've cycled through a lot of companies that look like, hey, maybe this will be future FAANG. Zoom, which we are on currently, still has usefulness. We're using it, but no one talks about that anymore. But back then, people were really talking about, yeah, I got in on that in March 2020, and made X 100% over the next 12 months. But that's, if you look at the chart now, it's came crashing back to earth. Uber's kind of another example. Not it's not as fickle as Zoom has been, but there's been a lot of potential candidates, but there's no obvious one to replace the FAANGs right now, other than Microsoft and possibly Tesla, just in terms of clicks.
Yeah, I do wonder if the pandemic maybe shortened the cycle for like identifying the next FAANGs, where okay, Zoom video in a normal environment maybe takes 5 years to go from 1 million daily active users to 17 million or whatever number it's at. I have no idea. I'm just pulling numbers out of the air. But the pandemic accelerated that to this ultra tight 2-year window where everybody was on Peloton, everybody's on Zoom, everybody's on the stocks that would have sort of naturally filtered up as being potential next FAANGs. And their hype cycle just got so shortened that now we don't have like the natural narrative that we might otherwise in a normal market condition.
Yeah, and it's probably not going to be a stock that has a product that does one thing. Zoom, we're doing it right now. We're doing it right now. Peloton, it's a bike. I mean, that's really oversimplifying it, obviously, but like Amazon, Apple, these are multi-pronged companies that have ever expanding functions and ever expanding revenue streams. So it has to be something like that to replace it, which is why Microsoft is such a good candidate.
Yeah, I think Microsoft and Tesla are probably the two best sort of replacement FAANGs. Tesla, not so much for the car company aspect, but for the big swings.
Right. Yeah.
And the fact that they're willing to take risks and do weird stuff. But Microsoft, I think if Microsoft had a better cultural perception of its brand in like 2006, it would have
Mhm.
been on the list. But
Yeah.
instead, everybody just looked at it as a boring computer and software company and not as like a trendy consumer tech company. Despite the fact that, you know, they tried their Zune player, they've got the Xbox console, they had a operating system for phones. I don't did Microsoft ever have their own phone hardware? I don't remember.
Not that I can remember now. No.
But yeah,
Um,
so I guess just that lack of appeal kept them off the list. But I think they belong there.
yeah. Microsoft is like the bad example right now, but the San Antonio Spurs of mega cap stocks, the St. Louis Cardinals, just always steady, strong, but no one talks about them. They're sort of boring.
Yeah.
Maybe the AI thing changes that, but we're still in the early stages of that, and you still don't see a whole lot about Microsoft other than ChatGPT.
Yeah, I wonder if they're going to get if some young sexy startup competitor is going to start getting all the headlines for their AI tech while Microsoft just puts in the work and just keeps rising like 20% a year and massively increasing revenues and just growing and growing.
Right.
I
Yeah.
mean that's how it played out 15 years ago, at least as far as the public perception. I wonder if that's what we see again.
Yeah. Well, one company that probably could have made a case at various points for joining is Disney. The reason I bring that up is I'm taking my kids to Disney next week, so we will not have a podcast next Friday. You took your family to Disney Land, since you live in
Yes.
Arizona. I'm headed to the Florida version, Disney World. Any tips before we sign
The,
off?
my main takeaway is that Disney is really, really good at what they do. And if
Yep.
you can spend money for an experience or to optimize an experience, do it. Like the extra $200 you spend or whatever to jump to the front of the line is money well spent.
Yeah.
And
My
also,
kids love it. My wife and I, we're going for 2 days. We're going to be in Delray, Florida for the rest of the trip. I'm looking forward to the Delray Beach portion of the trip. But I'm looking forward to my kids looking forward to this, to the Disney part.
yeah, that'll be a lot of fun.
Yeah.
Uh,
Yeah.
Take photos, make memories, have a good time.
Yeah. I'll report back in 2 weeks. We're on here. That'll be our whole podcast will be about that. No, maybe about Disney stock though. That'll be a good way to go. Any final words before we sign off?
Enjoy your vacation, and I'll see you in May.
Yeah, thank you. Yeah, May, crazy. Yeah, thanks everyone for joining Street Check. We will see you again, like Brad said, it'll be the first Friday in May, whatever that date is. And we will talk to you then.